Now it's time to bring in Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report, available at gloomboomdoom.com. So, Marc, tell us, is it recession or not a recession? Which is it?
Well, as you know, an economy is a very complex animal, and there are different sectors in an economy. So you could have a recession in some sectors of the economy and an expansion in other sectors. And that's the way I would also look at China. But in general, if you measure peak economic activity up to now, we're off peak economic activity, which occurred, say, in September, October last year. Right. And since then, there has been a remarkable slowdown. And if we look at trade figures around the world, which are a fairly good indicator of economic activity, in Asia, all countries have declining exports with the exception of India and Vietnam. So that tells you a little bit about the world and how it slowed down. You look at semiconductor sales, you look at car sales around the world, and you look at the trucking index, the Cass freight index, stocks like FedEx or UPS, how they perform. I'd say we are basically in a recession already. But you understand, government statistics are painting a rosy picture.
Sure.
The bond market is also telling you that we are essentially in a recession.
Yeah. So it's interesting that, obviously being a bond guy, I agree with that, and I see that first. And to me, it amazed me what happened back in December with interest rates. It seemed like that last hike in interest rates that the Federal Reserve made, basically the bond market said, enough, we're not happy with this. And it's almost like the bond market alone finally made the Federal Reserve change policy. Did you see that the same way?
Sure. It's very interesting what is happening in the bond market. But you understand, the bond market is very distorted, in particular outside the US, where you have $10 trillion worth of bonds having a negative yield.
Sure.
When I grew up in the 70s, as you know, we had at the time a rising interest rate structure when interest rates on T-bonds went to over 15%. I could never, this is the one thing I would never have dreamt in my life, to have negative interest rates.
Sure. So let me ask you, do you think during the next recession, which I assume if you feel like we're there now, that you probably agree that the media will finally start to have to admit it by, let's say, 2020, as many economists are now predicting. But do you think whenever that next official recession hits, will we go into negative interest rate territory this time here in the United States?
Well, that I don't know. Because, the situation is, again, very complex. Assuming interest rates in the US go down further. And just to give you an idea, we have in Italy bond yields that are not meaningfully higher than in the US. In the US, the bond yield is now 2.2% on the 10 years. In Italy, it's 2.10%.
I know.
In Spain, it's 0.39%. In Portugal, it's 0.54%. In Greece, it's 2.45%. So not much higher than in the US. So we have huge distortions.
And Greece should be close to 10% if you think about it with their situation, and some of these other countries should be much higher. So we need to take a quick commercial break, Marc, so please stay with us. We'll be right back in a moment. I want to hear more about that. And you stay with us too. We're here on The Income Generation. I'm Dave Scranton, and we'll be right back. And it's that time once again to bring back in Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report. So Marc, you feel like we're in recession. We talked about all the interest rates around the world being ridiculously low. Some a lot lower than ours, and arguably they shouldn't be. But, how much of the recession that we're starting to see now, or the recessionary signals that we're starting to see now here in the United States, are due to the actions of the Federal Reserve itself?
I do not think that the Federal Reserve bears any responsibility. On the contrary, the US Fed under Powell has been, and I emphasize this, relatively cautious and relatively responsible compared to the other central banks around the world. The problem we have today is that the asset markets are grossly inflated. You know, people talk about inflation and they measure consumer prices and so forth. But inflation is a manifestation of excessive monetary growth. And it can happen in wages, it can happen in commodities, it can happen in asset prices or consumer prices. Since 1981 up to today, we had a colossal, and I repeat, a colossal asset inflation with some interruptions. But basically, if you remember when you were young and you wanted to buy something, what the price was for a house, for a painting, for equities, for bonds, and what they are today. We have inflated asset markets.
Right.
And these inflated asset markets, once they no longer inflate, they'll produce a recession. Mm-hmm. So it's not the real economy that impacts the asset markets or the stock market. It's a stock market, the property market, the asset markets in general that have an impact on real economic activity.
So Marc, in the 1 minute or so we have left in this segment, tell our income generation viewers, you know, in your opinion, although the Fed seems to be doing a lot right, you seem to feel that way, and that's good. I'm glad to hear that. But do you believe that they've taken on a third mandate, essentially? And that third mandate is keeping Wall Street happy.
Yeah, I'm not sure they want to keep Wall Street happy, but I think some people at the Fed begin to realize that they created a Dracula, a monster that is now so big. How do you contain it? How do you prevent the stock market from collapsing? How do you prevent bonds from collapsing? Corporate bonds, government bonds, they can be manipulated, but corporate bonds are more difficult. And the stock market, as we've seen in Japan and in other parts of the world, in Japan, the BOJ buys equities through ETFs. I mean, I think eventually the Fed will also buy equities if the market goes down by more than 15%.
Well, and I think that's fine if they just come out and admit that that's what they're doing. The only troubles that I have is, you know, everybody says, well, that's not our mandate, we don't care, but the actions to me seem to say something different. So we need to come back for one more segment, take a quick commercial break. Stay with us, please, Marc. And you stay with us, too. We'll be right back here with more on the Income Generation. I'm David Scranton, and we'll be back in a moment. And now it's time to bring back for one last segment Marc Faber, editor, publisher of the Gloom, Boom, and Doom report, available at gloomboomdoom.com. So, okay, you think we're in a recession, although economists don't seem to be admitting it yet. Maybe they'll catch up with you and me next year and finally admit it. But can the Federal Reserve, through this asset inflation, if you will, keep the stock market relatively healthy, even if we do go into a recession? Is it a different world now in that regard?
Yes, that is possible, but I'd like to point out what I insinuated before. You understand, the dollar has a value against other currencies and against hard currencies such as gold and possibly bitcoins and so forth. If the Fed eases aggressively, I would expect the dollar to tumble. The dollar at this level by any means is overvalued. And if the dollar goes down, then the buyers of bonds would want to be compensated for the potential or the ongoing depreciation of the dollar. So even if the Fed eases, I'm not 100% sure that interest rates on long US bonds will go much lower. Now, can they go and test the lows of 2016 when the 10 years Treasury note was at 1.37%? Possible. May even go to 1%. As I said, in Europe, we have these very low interest rates compared to US rates. And I'd rather own a US Treasury than, say, Portuguese bonds. You understand?
Of course. But let me ask you this, though. If the dollar does weaken, isn't that going to drive foreign investment into our currency, into our bonds, and essentially bring back equilibrium?
Well, who knows? I mean, I think if the dollar weakens, as was the case in the 70s, we could have a pickup in inflation and we could have a flight out of US dollars, because don't forget, I'm a European insurance company. I'm a European billionaire. I see interest rates in Europe. I see interest rates in the US. I'm tempted to buy US bonds simply for the yield pickup, as well as a Japanese institution with negative interest rates in Japan will be essentially tempted to buy US bonds. Once the dollar goes and becomes weak, that money will flow out of US dollars, and that could have an impact on the capital market in the US. But look, I am the first one to admit we don't know how and when it will unravel. But we are in a very artificial situation, and it's unlikely to end well.
You know, it's funny. I always say, when you have a laboratory experiment, sometimes you get a great result, and sometimes a lab experiment ends up in an explosion. And this is ultimately the biggest economic laboratory experiment we've had in the history of our country. So you and I could sit here and jawbone about this, and I love your humility in that you say, hey, we really don't know. And that is the reality. We really don't know. Time will tell. But I think you'll agree that it's time for investors to at least be cautious. So, Marc, I want to thank you so much for your time today.
It's the greatest experiment in the history of your country. It's the greatest experiment in economics in the history of humankind.
In the history of the world. That's right.
Before have interest rates been this low.
That's right. And listen, Marc, we need to leave it there. Unfortunately, we're out of time. It's been my pleasure having you back on the show. Thank you so much.
Thank you so much.